Good. Thank you. So, while these gentlemen are being kitted up quickly, I'd much rather be where they're going to be seated than this side. My wife says that I'm not very good at listening. And I'm going to have to try and get a flow of discussion going here. If I'm sitting that side, all I need to do is listen to the question and then answer it. This side, I'm going to have to try and get conversation going. But my ear specialist says I'm 100%. There's no problem with my hearing. So at the end of today, it's going to be one of two things. Either I have a problem of selective hearing, so I choose to hear what my wife talks to me about, or I really don't have a problem at all. Now, I'll leave you to be the judges of that. I'm looking forward to a wonderful discussion here. We've got a nice balance of some corporate advisors and some asset managers here. And our discussion, gents, can I please make sure that your mics are on your tie or your shirt, not on the, I don't know what this is called, side of the jacket?
Lapel.
Lapel, okay. Because I noticed from previous ones that we do battle to hear when you're turning around. And that's why I've moved my chair this way so that I can face you and that you don't have to turn around too much. But remember, you're talking to the audience. They're more important than me. So make sure that we minimize the places where the audio disappears and fails us. Okay, guys, thanks very much. My panel has been introduced. Their bios are in the book, so in the interests of time, we've just had our panel discussion cut back by half an hour, which is fine. Guys, let's be succinct, to the point, and let's have an engaging discussion. But we are running behind time and have been asked by the Director of Ceremonies to ensure that we catch up on some time. But our discussion is divided into two sections. The first section is the right pitch, selling your business to the investors. And then the second part is how companies can attract funding. So there is a bit of an overlap between previous discussions. And my panel is well aware of that and will be efficient in the use of our time so that we don't repeat what other panelists have already touched upon. Okay, great. So let me start with Johan and Tapologo. Regarding the pitch, selling your business to investors. What information is critical for entrepreneurs to provide when pitching a business idea to investors? Okay? Who wants to go first? Johan?
Thank you, Martinus. Can you hear me? What is critical when you pitch something to investors, and obviously there's a difference between the unlisted space that we spoke about and the listed space, but the core remains the same. And that is, you must sell your concept, you must sell your business, you must indicate your profit history. It's different when you're a venture capital company, obviously, but your history is important because it shows whether your profit forecast can be made, is sustainable. So you must give the financial information, and I'm not going to repeat what the previous panelists have said, but the financial information forms the basis of your pitch. Then you must indicate your experience, your management team. Are they competent to fulfill what you are projecting out to the investor? Can they deliver on the growth prospects? Because guys will invest in your company if they believe in your growth prospects. Are you going to pay dividends in time? If you're a property company, what is your distribution going to be? So your pitch must be, what is the growth prospects of this company? Do I have the competence to deliver it? And can I give assurance to the market that this can happen? Obviously, there's many other things that come into play. If you have an IPO, you must indicate your barriers to entry. There's a lot of different things that you need to pitch as well. But the core is really, can I deliver on my growth prospects? And if I draw capital from the market, what will I do with that capital? How will I employ that capital? If I raise 100 million rand, where is that 100 million rand going to? And can that enhance my profit going forward?
Good. Thanks, Johan. Taps, from an investor point of view, what is the right pitch when an entrepreneur is looking to sell an idea to investors?
I think in addition to everything that Johan has just said, I think what matters a lot is track record, right? So if you are coming from an unlisted space and looking to attract capital from investors who typically invest on listed exchanges, it's important to demonstrate a track record that gives confidence, right? Because as Martin said on the previous panel, you'll be buying into what this business is going to do in the future. So it's very important that your previous track record, plus all your numbers that you would have put into your prospectus, convey adequate trust and confidence, such that market participants can take that leap of faith and part with their money to invest.
Okay. I want to now move on to Manu. From a corporate advisor's perspective, what are the critical things that go into packaging that business idea when you're selling it to investors, i.e. preparing a company for a listing?
Sure. Thank you so much. Good afternoon. So the role of a corporate finance advisor in any corporate finance activity, I know IPO is more relevant here, but other corporate finance activities like selling a business, buying a business, or even if you're going into the market raising debts, is quite significant. As an entrepreneur, it might be one of the most nerve-wracking experiences of your lifetime. You wouldn't come across such situations every day in your business life. So you need the right kind of expertise on board so that you package it in the right way and then you take it to the investor and make the right pitch. Because we might not have too many instances where we have a right shot at an investor. So what a corporate finance advisor brings onto the table is years of experience dealing such transactions, trying and testing various methods, and how to appropriately structure a deal and a transaction. If you look specific from an IPO point of view, I know it was covered in the previous panel, this one did mention about that. The role of a corporate finance advisor doesn't really start when you package or do the prospectus, but then you have to go back to grooming a business. So you want to advise the management and as to what they are targeting, what the business story is, and ensure that you have the proper structures, the committees, and the systems in place so that you have a business case which you can take it to the market. So I think the first and the foremost critical step you do as a corporate finance advisor is to sit with the management of the company and understand the road of the journey to the IPO. Are they ready for the IPO? And how far are they with an IPO process? If you go to the next stage in terms of packaging a prospectus, obviously prospectus is the Bible which the investor relies on to understand whether a particular business is worth investing into. So a lot of care has to be taken when you draft a prospectus. Typically, there are a few areas that an investor looks into in a prospectus. It might be the trading history. They would want to know how the company has been performing historically, what have been their major revenue lines, what have been their source of income, what sort of revenue sources they have. So trading history plays a big role in determining the success of an IPO. Secondly, you need to write a good business case around what and how the funds are going to be utilized by the company. So unless there is a strong business case, it will be very difficult to sell it to an institutional investor or even a retail institution. Third one is to create a governance structure for the company. So the role of a corporate finance advisor is not only about packaging a prospectus, but you'll have to look at the whole gamut of an IPO and walk along the journey with the management of the company.
Okay, good. Now, thanks for that. We'll come back if we have time to the governance structure,
Yeah.
just so that the audience can appreciate what structures are required if we have time. But BK, is it necessary for an application for a listing to be backed by, call it a sophisticated or an institutional investor? And what message does that send out to the rest of the market? Is it necessary? Does it make a difference?
Thanks, Martinus. From our standpoint, we don't think it's necessary to have sophisticated investors in the application. We think the role of the BSE listing committees is to ensure that there's proper disclosures of all key matters in the business proposal. It's important that the BSE vets the management of the business, whether they've been doing things right, the financials is accurate, and more importantly, that they don't let through people that have done fraudulent things in the past, be it in Botswana or in any other markets. What we do recognize that in Botswana, in terms of the BSE listings, they have a requirement to have an underwriting, which is typically done. Sometimes they can circumvent that if there's an undertaken by the professional investors, which will be deemed like an underwriting. I think from our standpoint, it's important because sometimes the presence of a sophisticated investors tends to imply other things. Typically, sophisticated investors, which are in Botswana asset managers, they are deemed to have the skills and the resources to undertake research, evaluate the prospects of a company, and say whether it's going to do well or not. Sometimes you'll find that people would simply invest on the basis that an institutional investor has invested. I think it's important that retail investors, particularly, the presence of a sophisticated investor does not mean that it's 100% risk-free. There are risks in investing. For example, if an institutional investor was to invest 10 million in a stock, people might perceive 10 million to be a lot of money and therefore mean that, this is a sure bet, it's going to do well, not realizing that that 10 million represents 1% of the portfolio of that manager. Retail investors might then go out and take all that life savings and invest it wholly in a risky business, meaning that they've committed 100% of their wealth in that one stock. We also think that it's quite important that, governance is looked at very strongly. And I think that this is mainly because as investors, we're not involved in the day-to-day running of the businesses. Therefore, we need to make sure that our interests are protected. And you need to look at the governance structures in the company, make sure that there are independent directors, the chairman is independent of the business. By and large, what we would say is that retail investors need to do their own research. It's important that they do that before investing, despite the presence of a sophisticated investor. Ultimately, this takes a lot of effort and time. Some might have the expertise, some might not. If you don't have the expertise, it's better that you engage with a financial advisor to assist you, either to buy a stock which is appropriate for your risk appetite and investment objectives, or to look for an investment vehicle like a unit trust, which has got your appropriate risk profile investment objectives.
Okay. BK, you mentioned a point around the need for an underwriter and the role that such a requirement plays, particularly when you look at the retail investors. Johan, help me here. What are the evolving trends, whether from a global perspective or from a South African perspective, with respect to the requirement for an underwriter? And does that, we're talking here about the building of confidence, where you've got retail investors who don't have access to information, who don't have the skills, and therefore a reliance on more sophisticated investors such as institutional investors. What do you see?
Yeah, the rationale for underwriting is clear, and that is to ensure a successful listing.
So you want to define underwriting?
Yeah, underwriting, I'm about to do that.
Cool.
So if you require 100 million rand and retail investors only put in 60 million, there's usually an institution that will provide the other 40 million. If that is, so they underwrite the whole listing and will pitch in what funds cannot be raised in the marketplace. So the rationale is quite clear, but the trends globally and especially also in South Africa is to move away from underwriting where you've got certainty, where you've got irrevocable undertakings, where you've got big institutions already backing you. So underwriting is there for specific cases from a global perspective, but not necessarily for every listing.
Okay, good. Now, thanks for clarifying that. Manu, I just want to go back to you very briefly. Just talk about the governance framework. When you are preparing an enterprise for becoming a listed entity, what are some of the governance framework aspects that need to be considered?
Thank you. So the common governance weakness that we find around companies, SMMEs, that hold the autonomy and power close to chest is that they don't want to sort of dissolve the autonomy and distribute the information publicly. So what we are talking about is a situation wherein there are a lot of companies that are doing the same business, but then they operate as standalone companies. So the risk of the owner not distinguishing himself from the business leads to a situation wherein the corporate veil is being compromised. So corporate veil is basically the legal concept that gives the company the independence and separation as a separate legal entity. So as soon as there is a poor governance around the operations of the companies, there is risk around the company losing the identity of a separate legal entity. So there is an English proverb which says, there's no pillow as soft as a clear conscience. So if you look at a corporate parlance, it's basically the corporate governance that drives the business and gives comfort for the business. If you look from an IPO or a corporate finance activity where you're going into the market, it has been proved by the researchers that investors attach a lot of premium to the companies that has a strong corporate governance framework.
Right.
A recent research by McKinsey has proved that investors as high as 80% attach close to 20% premium on companies that has good governance frameworks, which is a substantial amount of premium if you see from an investment point of view. Also, when you take a company for an IPO, you want to make sure that you have legitimate structures in place so that the ownership is separated from the control. So some of the key aspects from an IPO point of view, or some of the key structures that you can put up is basically to increase the number of non-executive directors, which again has proved that it tends to increase the efficiency and the sustainability of the business. Same like is the concept of separating the role of a chairman from the CEO, which again gives an independent to each role. Likewise, setting up an audit committee and also bringing institutional investors on board all has proved that it can increase the sustainability and the firm performance. But again, it's a very fine line. There are researchers which prove the other way also. For example, if you look at the company Berkshire Hathaway, it's a Warren Buffett-owned company, you see the majority of the shareholders and directors are closely held and are relatives of the family. But then the company has been historically giving around 20% return to the investors and is one of the most ethically run companies. So if I might conclude, it's all in the spirit of the compliance and what the management wants to do with it. Thanks.
Good. Thanks, Manu. Right. I want to move now quickly to the second part, which is how companies can attract funding. So turning to you, Taps, how do you think companies should visibly position themselves for an IPO from where you sit as an investor?
I think from my perspective, certainly when the companies get to the stage where they've got a prospectus and they give us their numbers, we can go through those. But before they get to that point, it is useful if you have a sense as to whether a business is even listable or not, right? So let's take the example of Choppies. Before Choppies listed, it was certainly a very high-profile business. It is evident that there were a lot of shops around the country and they were growing rapidly. These are all things that you could see even before you had seen the income statement or the balance sheet. There's a very clear brand, so you had a sense that this is potentially a listable business. And I would certainly say that public profile that the business built, and I'm not even sure that they did it because they wanted to list. I think they just did it because it was good business. But doing that certainly helps aid the public profile. And it puts the idea in potential investors' minds that this is a listable business. I think when you've got other businesses that are not necessarily retail or direct consumer focused, the job becomes a bit harder. And typically companies that are in the services industry, sometimes property companies fall into this category. But then other things you could do is you could profile either the achievements of the management team. So for example, if the management team happen to have won, say, entrepreneurial awards, or they've done something particularly notable, or some of the underlying assets of the business are noteworthy in a particular respect, if these things are given an adequate or reasonably high public profile, then this puts the idea in the minds of potential investors that this might be a listable business. I mean, not to put them on the spot, and I know they're often spoken about as a listable candidate, but Motovac, right? This is a business that we all know. All the minibus combis in this market buy most of their parts from. On the face of it, and I've never seen Motovac's numbers, but for example, that is probably a business that could be listable, right? So I would just say that for the entrepreneurs in the room today and who are listening to this, to the extent that you are not doing this, where your business has achievements that are noteworthy and could be publicly profiled, I would certainly encourage you to do so.
Okay. So Tabs, you talked about businesses that are already visible, and you used an example such as Choppies and Motovac. BK, what about a business that is a startup? So there's no track record, there's no visibility. What are the key considerations as an investor that you are looking for? Because here's a business that's wanting to make itself attractive, to draw on capital from the capital markets. What do you look at?
Because of no track record, we will then solely focus on the management. Because ultimately, if you invest in a business, you're effectively backing the management to create shareholder for you in future. Now, when you invest, management can either destroy value or create value. So it's important that you have the confidence in the management in terms of their competency, their experience, what have they done in the past, and so forth. It's important that you analyze the management to make sure that if they raise money from an IPO, they are able to execute a strategy that they are saying they are going to. A case in point is Tenstar, for example.
Yeah.
When Tenstar listed, it didn't have a track record. It was a new listed entity. But one of the major founding shareholders had property experience in Botswana. He had done a lot of developments, and therefore this gave him credibility in terms of able to sell the ability to do a development, which was a game city at the time. Now, because of the visibility that investors show from leases that were going to be signed and so forth, they were confident reasonably in their success.
Yeah.
One of the other things sometimes is that you'll find that not everybody will have a track record. I think that's the reality. But some people will have concepts which are very good, compelling, but they just don't have the track record. I think it becomes very difficult for new concepts because investors then start to look at the concept and say, is it viable? But one of the key things that we would look at is there a market for the product? Is there a need for it? How does it differentiate between other products that it's looking to compete in? Are there competitors in the industry that it's looking at entering to? Then you'd want to look at least the management in terms of, is the management competent? Do they have integrity? Do they have the best intentions of running this thing? And most importantly, are they invested in the business? Have they committed capital?
Yeah.
So that they sit in the same side
yes.
as the other investors that are going to invest in. I think it's always a difficult one for startups because people can easily get swayed by doing a forecast and have numbers which are saying profits are going to increase by 50% for the next 5 years, margins are going to be 40%. The reality is, in the real world, things don't happen as planned. And sometimes forecasts that we normally see tend to be very, very optimistic. They tend not to be realistic. So we would look at the forecasts and take them with a pinch of salt and see the practical realities of where we think the fair business would be. We'd also take into consideration the valuation, of what we think is a fair price. It's always a difficult one when there's no track record or no assets as well. So it becomes a subjective element in terms of how much do you think the idea is worth, in terms of is it going to change something. From an institutional standpoint, obviously we will not invest a lot of money in it because you're not confident how it's going to turn out. The reality is new businesses sometimes do well. You can have a company list and become very significant. In the same token, you can have a company list and disappear. So one needs to manage the risk and be comfortable with the exposures that they're taking in the companies.
I guess a good example of that is Affinitas, where there was no track record as an entity. I know you mentioned Turnstile, but here, how do you value, Affinitas when it came to the market? That must have been something quite difficult. It must have been a challenge. But I'm not asking you to answer that. I'm just making a comment that there, again, to your point, the reliance on the promoters and their track records in their previous lives becomes something that is quite important. I guess, because we're running out of time, a nice way to round off this subject of how companies can attract funding is to ask Johan, earlier on I heard in another panel Bashi talking about crowdfunding, peer-to-peer lending. What are the alternative sources of funding? Because I'm sure entrepreneurs in this room, we've been talking about the capital markets, and they're used to, they have very good relationships with their bankers. We have some bankers here. So in a way, the capital market competes with the bankers. But what are the other alternatives? I think it would be useful for entrepreneurs to know what else is out there. And does this pose a threat, these other forms of funding? Do they pose a threat to the capital markets?
Thank you, Martinus. No, I don't think they pose a threat because it's all complementary. It depends where you are in your life cycle. You'll have crowdfunding and peer-to-peer funding when you're sort of starting up as a business or still in the infancy phase.
Do you want to just define crowdfunding?
Crowdfunding is usually on, and I'm just going to summarize it quickly, on social networks, Facebook, where you sell your investment concept and get other sort of internet users to sort of back you, family or friends, if I can put it that simply. And I think a previous speaker did elaborate on that and in the US, what happens there, and all kinds of other regulations. But that's a simple form of raising not huge amount of money, but small numbers. Peer-to-peer is where there's a network that's created and a borrower and a lender is put in touch with each other. There's examples in the world, UK, in the US, and South Africa. There's Rainfin as an example, and Lendico. One is backed by MTN and the other one by Barclays. But they typically put lenders in touch with each other that wants to borrow from 100 Rand to 500,000. So those are the size. Then if you look at alternatives, and those are in the infancy phases, if you then go, then there's obviously private equity that can play a role. If your company is not 100% ready for a listing, they can add value, get your corporate governance in place, and then you get the finance to build your business out further and prove your business case before you list it. Private investors can play a role, and obviously bankers and the listing is not in competition with each other because you always, as a listed entity, need other debt sources and funding available.
That's true.
I don't know if that answers your question.
It does. Well, we've run out of time, but I want to thank my panel, and hopefully we have really unpacked what needs to be done in order for you to sell your company and to make it attractive and to attract the funding that you need. So I'd like to thank the panel for making it simple, demystifying. My colleague Bakang kept on talking about we're going to demystify. So I hope you've done that, but only the audience can be a judge to that. But I want to thank you all for your contribution. Thanks very much.
Thank